Hello, Namaskar viewers. I am Sanjeev Pandya welcoming you to another episode of Money Talks right here on ITV Gold Season 5 with Mr. Ajay Kumar of Science CPS Services. And in this show, Money Talks, we talk about money and topics related to money. And this is basically just to inform you, just to, guide you and let you know about Money Talks. Because why Money Talks? Because money makes money, and that's what the show is all about. The show is brought to you by Sai CPA Services, a professional accounting firm located in state of New Jersey, multiple locations. So wherever you are in the US and whatever tax related matters you have and need advice and a professional guidance, you can contact Sai CPA Services at 908 888 8900 or visit their website, Science CPS Services. They're trained, knowledgeable, and a professional CPAs, on-hand CPAs will help you, will navigate you, and will guide you in the right direction. So remember, no question is a small question for any tax-related matters or even IRS tax audit that you may have received. For that, contact Science CPA Services here in New Jersey. With that note, I'd like to welcome Mr. Ajay Kumar of Science CPA Services. He's a CPA, MBA, and a CBA with over 25 years of experience. He's joining us right now, once again, in the show Money Talks. And when Ajay talks about money, everybody listens. Ajay, welcome to the show.
Thank you, Sanjeev. Thank you for the kind introduction.
Sure, absolutely. Money talks is money talks, right? Money makes money. So when you put money in the right place, that money makes money, and when that money is making money, the money talks, and that's what thing is all about. And there are very smart investment strategies for long-term wealth planning that you should know. We actually started to cover this last week, and there are 10 points that AJ has come up with it. That what are those smart investing areas? There are total 10 of them, and we covered 5 of them last week, and we're just going to give a little overview and then quickly go on to the other ones, so that way you have a complete knowledge of this smart investing for long-term wealth planning. Remember one thing, that when you have money, you need to make sure that there is a long-term security. All right, AJ, you did cover 5 points very, very well last time, and it was very interesting. Now let's start with number 6, which is mutual funds and CDs.
Absolutely. But for the benefit of our viewers, Sanjeev ji, we want to make sure they understand what we are trying to do. If you just joined, if you missed our last episode, please understand we are talking about 10 assets that you should be investing in for wealth building. If you are making $100,000, if you are making $200,000, if you are making $500,000, unless you are saving money, unless you are building wealth, money comes in, money goes out, and there is nothing to show off. You will need a lot of money for your retirement, for emergency fund, for medical expenses, for long-term care. Make sure you're building wealth, not just earning. 2 different things. Earning is very different than saving. You can save more money even if you are making less money. Making money is good, but saving money is more important. So last week, we talked about 5 assets. We talked about investing into real estate. We talked about investing into stocks and mutual funds. We also talked about investing into yourself. People like us, first generation, we came into this country with absolutely nothing. MBA, CPA, CVA, the business valuation licenses, wealth building licenses, wealth planning licenses. This is called self-education, self-investment, investing into your own professional education.
Develop your skills and find that talent within you and educate yourself, because education is very, very key.
Absolutely. So if you missed our last week's episode, please check it out. It's on YouTube, it's on several social media channels. Please make sure you check it out. In today's episode, we'll talk about the remaining 5 assets that we could not talk about, that we could not finish in our last week's episode.
Absolutely. We're going to start with that. But one more thing I'd like to add, that last week you discussed business ownership.
Absolutely.
Also one of the smart, assets for the long-term wealth planning. Anyway, let's start with number 6 right now. Number 6 is mutual funds and ETFs, which is also mutual funds. They say you need to have patience. Once you have patience, mutual funds can reward you very, very well. But it's a safe investment, but you just need to have a really lot of patience, right?
We want our viewers to understand what is mutual fund, what is ETF,
Yes.
what is exchange traded fund as opposed to mutual fund. So mutual fund, as the name suggests, is a fund where there are a lot of assets, lot of stocks combined together. Mutual funds could be based on healthcare, could be based on IT sector. There could be industry-specific mutual funds. There could be country-specific mutual fund. There could be size-specific mutual fund. All the companies above this size or below this size. So there are mutual funds on many different areas. You decide what makes sense, what you believe in. Instead of investing into one particular stock, investing into a mutual fund, or for that matter, ETF, is considered as safer or more safe than investing into one particular stock. The theory is when one stock is going up, generally speaking, the opposite of this stock, the opposite industry will try to come down. Meaning, let's say, coal and gas. If gas is going up, coal will go down. If coal is going up, gas will go down. If you are investing into both of these assets, then you know over the period of time, they will both be doing okay, as opposed to taking risk in investing into one of them. So the idea behind mutual fund is more so industry specific than ETF, where it's exchange specific, where you say the top 500 stocks listed on NASDAQ, top 1,000 stocks that Russell fund is investing in, top S&P 500. So you have exchange-specific stocks coupled together, combined together, and traded on exchange funds as a single stock, as a single unit. That definition is ETF. They work for all practical purpose, more like stocks, meaning you can buy and sell for any amount you choose. There is no minimum requirement for most funds. Mostly ETF, there is no minimum requirement. Some mutual funds have some requirements where you have to invest X amount of money, but there are enough mutual funds where you can invest as much as you want or as little as you want.
Very
the
well.
idea here is investing into mutual funds and or ETF, more so that on ETF side, is less riskier than investing into stocks.
Less riskier, and when there is a less riskier, there is also a little reward. It takes time. Reward is there, but not a very aggressive or handsome reward like you would have in the stock market. That's why you need to have
Yes,
patience.
more risk, more reward.
Yes,
Absolutely.
exactly. So that's the mutual funds and ETFs. Thank you, Ajay, for that. Now let's go into the next one, which is called fixed income investments.
So there are a lot of assets that produces fixed income. So a lot of larger companies, billion-dollar companies, will issue bonds. You can buy Treasury bonds. You can buy private company bonds. They are AAA rated. They can give as much as 10% interest every month. They have dividend-giving stocks. The idea here is when you have larger portfolio, especially depending on your age, when you are at that age of retirement, you want to make sure some income is coming to you every month consistently without you thinking about it, without you worrying about it. So generally speaking, bonds are considered a secure asset, a more safer asset compared to any mutual fund, ETF, and or stocks, for example. Because bonds are guaranteed by the credibility of the company. Let's say, for example, Microsoft, they need to raise $100 million. So instead of issuing more stocks, they will say anybody who wants to buy the bond, the legal document, will pay 10%. Very, very common, which is guaranteed by Microsoft's billions of dollars worth of assets. So these bonds are generally a smaller amount compared to the company's size in total. So AAA bond, very, very safe bond. But safer the bond again, lesser the return. But when you are looking at retirement, when you are looking at consistent income, please try to go on the safer side. Don't take too many risks when it comes to consistent monthly income.
All right. Yeah, here, can we add a little more on municipal bonds and U.S. Treasury bonds, because they also issue bonds and they're also safer? If you can highlight those.
Absolutely. If tax is an angle, meaning if you want bonds where you don't have to pay any taxes, municipality bonds, Treasury bonds are also very, very good option. Municipality bonds, as the name says, are guaranteed by the municipal government. Treasury bonds are guaranteed by the credibility of the US government, meaning they are the safest possible bond. Of course, their return is lesser. So in the order of return, lowest Treasury bond, then municipality bond, then private company bonds. Even in the private company bond, you can have a AAA bond, AA bond, and double B and A bond.
Yes.
Meaning higher the guaranteed return, lesser the return, lesser the the amount of money you can expect from the bond.
Yep. Very, very safe investment. And for the retired people, this is one of the safest investments that you don't need to worry about it. Moving on to the next one, as we are talking about smart assets for long-term wealth planning. In today's day and age, digital is all around us. We live in digital era. Everything is digital. How can a digital can be part of one of the smart assets for long-term wealth building? AJ, if you can shed some light on that.
Absolutely. And the funny thing is, when we talk about digital asset, the very first thing people ask me, cryptocurrency. When we talk about digital asset, we are not talking about cryptocurrency only. Of course, cryptocurrency is a digital asset. But take a step back. Digital asset means an asset that's digitally, electronically available to you. Say, for example, if you are a small business owner, your business is only worth based on the cash flow you can produce. But if you have a digital asset linked to your business, let's say, for example, a CPA practice is worth X amount. But if I can create a digital asset, meaning I do, let's say, 1,000 taxes. Anybody who has any question about their tax return, they can go on my website using AI, they can write any question and they will get an answer immediately. That software, that asset is going to be worth more than the practice itself. Meaning an asset that can help people do something that's not currently available, and that asset is digitally available. The key, when we talk about digital asset, the key is no manual involvement, meaning without me being there, without having any labor force, the asset survives, asset produces cash flow without any human intervention. Digital asset is the key to go for the next generation.
Oh, absolutely. That's the line I was going to say. That is the future, digital online investment. With that note, viewers, we need to take a short break. We'll be right back after this messages. You're watching Money Talks, Season 5 with Ajay Kumar. Moving on to the show, Money Talks, where we are talking smart assets for the long-term wealth building and the wealth planning, because one should always think about the future. You need to be proactive that what's going to happen after I retire, what's going to happen after I'm 60, 65, 70, 75. It's good to make money and it's good to invest money in some ways, but figure out the smart ways to invest your money so that way your wealth is keep building up. And that's exactly what we are discussing here. Mr. Ajay Kumar of Science CPA Services brought in a 10 smart assets, list of 10 smart assets. We covered so far 8 of them. And now we're going to go to the remaining 2 of them right here. And, Ajay, I'm surprised to see in your list that you have insurance and asset protection as one of the smart assets to build long-term wealth.
Absolutely, Sanjeev. It's important. It's extremely important. You have worked all your life. Towards the end of your life, you made a small mistake. You don't want to end up losing all the assets that you have worked hard all your life. So having the right insurance, be it the life insurance, be it the business owner's insurance, it could be the disability insurance, it could be the health insurance, but not having the insurance is not an option. You have to make sure what you have earned, what you have made throughout your life, you are protecting it somehow. You know, the number one reason why people stop working, people work 20 hours a day. They work crazy. But as soon as they start feeling unhealthy, when they have stomach pain, they have back pain, it doesn't matter anymore. It doesn't matter how much money they can make, they will stop working because health comes first. Make sure you have the right health insurance, right life insurance, business owner's insurance, some sort of umbrella insurance. Make sure you're protecting what you have earned, what you have made. So as much as we talk about the 10 assets you want to invest in, we want to remind our viewers to make sure asset protection is equally important as asset building.
Okay. And in that, key word is insurance, to have life insurance. That is absolutely important, for yourself and for your loved ones, to have a safety net for them. That's why you need to have this life insurance. And now it makes sense. And insurance and asset protection is extremely important. One of the most important things in the life for everyone out there, which is the estate. Estate is extremely important. When we talk about estate, AJ, can we cover estate, wills, trust. I know you have I guess unpacked information about this estate. So can we talk about that estate and the planning of it?
Absolutely. We can talk about briefly when it comes to estate, trust, will, the planning around it. And we are planning a separate episode. We have seen a lot of questions, a lot of emails, a lot of phone calls about estate planning. People are getting extremely concerned. The number one question that we are asked, at what wealth level, how much money I have to have in order to start thinking about trust planning, estate planning. Let's understand the concept first, and then you can help make the decision as what's needed and when it's needed. So will is a document. It includes the health directives. It includes how the assets should be distributed. It also includes if you are incapacitated, how the decisions are going to be made on your behalf. So it's 7, 8 documents added together, and as an umbrella, they are referred as a will. Will means what I want to be done in case I'm not available or if I'm not able to make the decision. That document, that instrument, everyone should have. It's irrespective of the wealth level. Everybody in this country should have a will. The best part, it's not expensive. You can do it yourself on internet. You can have an attorney do it for you. It's a matter of few $100s only. So having a will is a great idea. Now, estate planning is another concept. Estate planning means how do I move my assets to the next generation? How much assets you have to have? Well, it depends. Right now, the inheritance tax is over 15 million. So it's up to 15 million per person. So married filing joint, husband, wife has $30 million lifetime estate limit. They can give away up to 30 million. And again, married filing joint, 2 people, 15 each, 30 million to anybody, to their next generation, 30 million. And there is no taxes as long as the money is given or these assets are given to their next generation. If you are giving the assets to friends, family, second cousin, then there may be some tax consequences around it, but we can talk about it separately. The idea here is if you think your assets will cross 30 million in your lifetime, assuming 10% interest, if you have 5 million now, in probably 20 years, your assets will be 40 million. 5 becomes 10, 10 becomes 20, 20 becomes 40. If you are 60, you want to make sure, and your assets are 3 million. It's a good idea to have some estate planning done. If you are 30 years old and you have $3 million, it's a good idea to start talking about it, start thinking about it. So it's not just a fixed magic number as when you start thinking about the estate planning. You also have to look at how your assets are expected to grow, what's your age, and who are going to be the beneficiary for your asset. Meaning, if you have only one son, then probably nobody is there to dispute the asset. But if you have 15 children, exaggerating, then you may want to consider estate planning sooner than later. If you have a situation where you have a stepfather, a stepdaughter, a stepson, all the more reasons for you to have an instrument written up properly and estate planning done properly to avoid probate. Trust is an instrument that's used as part of the estate planning. In general, depending on the age, the younger you are, more than likely will probably use a revocable trust that you can change over the time. You can add more assets to it. If you are on the older side, sometimes we use irrevocable trust when we know that an irrevocable trust is not commonly used. It's used when you are giving up the asset forever or giving up an asset which is expected to grow substantially in value. Let's say if you have an asset which is worth 5 million now. If you give it away via an irrevocable trust, then your gift limit is 5 million. This asset becomes 50 million tomorrow. It's only counted as 5 million because it was 5 million when you gave it away. So when you have an asset which is increasing in value, sometimes irrevocable trust is also considered. So it's a huge concept. You have to really see where you stand, what's your net worth, what's your earning, what's your age, how many children you have, who are the beneficiary going to be, and then decide, do I need a will? Should I have the trust? If I want the trust, is it going to be a remainder trust, charitable trust? Is it going to be revocable, irrevocable? Do I want the proper estate planning done? And then take a step back and see, okay, this is how. Having a conversation with an accountant, with a CPA, with an estate planning attorney is also a very good idea if you are inclined towards it. Make sure you find the right trustee for your trust, executor, the person who will be making the decision. You don't want somebody who may not be fair, who may be biased. Let's say if you are having your friend's friend becoming the executor on your trust, and that friend's friend has a soft heart for one of the party, that may create a conflict of interest type of situation. So as much as it's important to have the trust, the estate planning, there are a lot of factors around it.
And I think we're going to cover those factors when we do a
Absolutely.
special
So we'll
show
have
on
to
it,
have
because we
a
are running out of
separate
time
episode.
here. We are running out of time here.
Absolutely.
AJ has given so much information on that part. So when you say you have multiple children, then definitely estate planning is important. So in that case, what about Elon Musk having this bunch of children and
Well,
being
in
the
that-
richest man in the world?
In his case, he must have the estate planning done. He probably did. I mean,
Yeah.
I'm not at that level to know it, but his net worth is pretty high.
Yes.
So in his case, is must.
He
We are
has to.
talking about our viewers, people whose net worth is 1 million to 10 million.
They need to do
In
that.
those cases,
Okay.
also is important, depending
Alright.
on their age, depending on their earning resources, and that's why we'll have a separate full episode only on estate and trust planning.
All right. Okay. Very well, AJ. We covered all the 10 smart assets. The reason I'm rushing because I've been told by the production manager that we're running out of time. So smart assets for wealth building. In the 2 episodes, this one and the one before, we covered following: real estate, retirement accounts, stocks and equity investments, professional skills and education, business ownership, mutual funds and ETFs, fixed income investments, digital online assets, insurance and asset protection, and estate and legacy planning. These are the 10 smart assets that we covered in our show. AJ gave us a lot of really good information, part of that, because this is where these smart assets, any one of them, any 2 of them, any 3 of them, will help you to build your long-term wealth. And that's why it's important for long-term wealth planning. Any question you have or any information you really need to know, of course, you can visit sciencecpaservices.com and then send a message for AJ to respond, or send an email, iq@itvgold.com. That's the email ID, iq@itvgold.com. With that note, we come to an end of this episode, Money Talk Season 5. AJ, thank you so very much.
Absolutely.
And wait for our next episode. We're going to have more information coming from AJ of Science CPS Services. I'm Sanjeev Pandya, wishing you all happy and wealth planning days ahead. Happy wealth planning days ahead. So long.
Thank you.